Good afternoon, everybody, and welcome to this month's webinar, Strategic Exits, Writing Your Company's Happily Ever After. So today's webinar is presented by Northstar Strategic Partners. So who is Northstar? We are a team of business strategists focused on helping your business increase profits. We ask the questions that you may not think to ask and examine the issues that may not always be at a surface level. Northstar has helped numerous customers achieve, grow, and maintain prosperous businesses over the years. Our speaker for today is Wendy Roberts. Wendy prides herself on creating winning strategies while helping her customers maximize their resources and their profits. As a CPA, she knows her way around corporate financials. As a former corporate finance executive and startup CFO, Wendy offers a broad insight into finding solutions to help her customers achieve exceptional growth and financial success. She has a bachelor's degree in accounting from Indiana University, MBA courses at University of Tampa, and years of experience counseling customers on financial and profitable success. Wendy is a member of Audit Committee and a published author. She is originally from the Midwest and was raised in a working class family. One of her most favorite and cherished hobbies is cycling. She never fails to miss a weekend cycling in the Bay Area. So, a couple of house rules: all questions will be answered towards the end of this webinar. A recording will be sent along with a short survey to the email addresses you used to register. So, let us hear it from Wendy.
Thank you, Shai, and thank you to everyone who's on this webinar. Today, my hope is that I can give you some trinkets that you can take with you as you are running your business and maybe be thinking about an exit strategy sometime in the future. So we're going to be talking about the 4 Points of Focus, the book that I wrote, The Only Business Compass You Will Ever Need, as well as what we talk about in the last chapter of that book about strategic exits, how to exit your business and what to look for. That's what we're going to talk about today. But let me give you a little bit a precursor and a little bit, for those of you who've been on several of our webinars, a little bit of refresher about the 4 Points of Focus and why I think that's important. Building a company of value means a lot to any small business owner. You work every single day in your business. Why not create a company that has some value when you're ready to exit? Our premise here at Northstar and within the book, The Only Business Compass You Will Ever Need, is a concept called the 4 Points of Focus. Now, what they do, they have 4 different areas. I'm going to go over those very briefly. The first one is marketing strategies. Now, marketing is very broad. We all know that. It's about a website, it's about SEO, all kinds of things, networking, referral, etc. That's all encompassing marketing. But we're very specific in our strategy, and that is you have to know your ideal customer. Who is it that you want to attract to bring in profits to your business? How do you talk to that customer? And what does it cost you to do that? The more effective you are in your marketing strategy, the more you're going to get leads within your marketing strategy that turns into sales, that turns into paying customers, that turns into revenue, which is the lifeblood of your company. So red in our 4 points, the marketing strategies, means target. Targeting that ideal customer. The second element in our 4 points of focus is financial structure and growth. It means money. You have to have net profit. You got to make money so you can pour money back into your company and also to pay yourself. You work way too hard for making zero money. So financial structure and growth, in that chapter, we talk about how do you create more cash flow in your business? How do you make it more attractive so that you can then create more additional revenue and more business into your company so that you can have more money to scale? The third area is operational excellence. Now, this talks about optimization. That's the orange. So optimizing using automation to the best extent you can. We all have heard of ChatGPT. We've heard of AI, artificial intelligence. There are tools out there that can make you much more efficient, especially if you're using an accounting system. There's opportunities to get rid of manual processes, as well as standard operating procedures where your people know what they're supposed to do day in and day out. And the last point of focus, the fourth one, is people and team building. And that's the blue for trust. Trusting in your team, knowing that they have your back, and creating a culture that creates more opportunity for them and also opportunity for you to grow a very successful business. Now, when we're talking about creating an organization of value, using those 4 points of focus, we want to think about 3 different objectives. The first one being profitability. We've talked about this already. It's about creating net profit so that you can pay yourself, take money out of your business if you need to invest it in other things, or taking those profits and reinvesting into that business. So profitability is the objective number 1 of creating a company of value using the 4 points of focus. The second is sustainability, sustaining that profit over a period of time, day in, day out, month in, month out, year over year, creating that profitability and sustaining it will create a company of value beyond your imagination. And the third point is scalability. So the more profits you have, the more sustainable they are, the better your opportunities to scale your business. So if you think about being able to build a company, let's say from 200,000 to 500,000 in revenue, $1 million in revenue, $5 million in revenue, can you see the ability to be able to create more profit, sustain that profit, and do it with scalability is going to create more value that someone is going to pay a premium for sometime in the future. Now, when we talk about the 4 points of focus, it really is a magic formula for success. When you talk about the marketing strategies, those are the elements that build people coming to you. You're building a brand. They get to know who you are. They want to do business with you. If you achieve 80% or more on that particular point of focus, you're going to be able to move into your financial success because marketing drives sales. Sales drive revenue, and revenue determines your financial success. So if you score at least 80% on that quadrant, the green, the money quadrant, that's going to leave you down into your operational success. So when you have automation, you're able to put more money into creating more opportunities for you and your employees and attract more customers because you're investing in your business. And as you invest in your business with operational success and you score 80% on that quadrant, that's going to leave you down into people and team building. Your team is your success. Having the idea and the motivation to be able to create opportunities for your team and they having your back, That will create a full circle of marketing success, financial success, operational success, and people and team building success, all creating an 80% or greater margin is going to give you those three objectives of profitability, sustainability, and scalability. And you will have a very successful, profitable business that you will be very proud of. And someone is going to come along and more than likely pay you a lot of money to do it, for you to sell. So let's talk about some common exit strategies. Once you've built your company to this wonderful, that has an opportunity for an exit, and you say, I want to look at different opportunities. So let's talk about what they look like. So initial public offering. These are usually, I would say, companies that are in the VC, venture capital, PE, private equity space, or you could actually maybe do this if you have plenty of capital. I will tell you that when I was a CFO for a startup, a software startup that we sold to a public company, we looked at a merger or acquisition by a strategic partner or an initial public offering. It is very expensive. You got to have audited financial statements. You need to have someone like a broker to help you go through that process. You need lots of lawyers. So there is an investment that you have. But I will tell you, it's very rewarding. I've been fortunate enough to be on the opening bell of the NASDAQ. It was a wonderful experience with a spin out that we took public. So it was really fun. But I will say there is a lot of effort that goes into it. The second is a merger or acquisition. Now, this could come in a couple of different ways. Number one is if you do a merger, you're doing a joint venture perhaps. So you might be with one company and both of you are about equal in size, and you have a common goal and you want to merge together. So you can either do a joint venture or you can merge both companies. Maybe do a stock exchange, whatever the case may be. But a merger is that kind of element where your two companies that are pretty much the same. You may be slightly different in your customer base and all of that, but you see some synergy between each other that you can create a much more profitable, much more scalable business. Another avenue is called acquisition. And this can be a couple of different ways. This can be by an individual where someone, let's say, is leaving corporate and they have some cash and they want to buy a company. They would come looking for you to buy your company, and that's usually through an M&A or a business broker. The second element might be a financial buyout. Let's say you've got a company that's looking to do an expansion, perhaps, or they want to invest in you for investment purposes. There's companies out there that do acquisitions for investment. And a third way to be acquired is by a strategic partner. And when I mentioned to you I was CFO for that startup that we sold to a public company, that was a strategic buyout by that much larger company. Another way you can be able to exit your business is through an employee buyout. Now, these are probably more prevalent than what you might think. And it's usually your key employees that already have some business experience. And it can be a great opportunity for you because it continues your legacy within that company, but then you can step out of the business. And it gives your employees, those loyal employees, an opportunity to continue running the business. The fourth area is succession planning, such as with a family member. There are a lot of family-owned businesses out there across the United States. And there's opportunities for an older individual who's ready to move through the exit process to sell it to their children, whatever the case may be. And the last one is called liquidation. And while I don't think this is the best option, sometimes it is just part of the process. Maybe, for example, you've put 40 years into this business and you really don't want to see anyone else own it. It's been your baby for 40 years, and I get that. So liquidation just means you sell off all the assets, you get what cash you can, and you shut down. So let's talk about the 4 points of focus again, right? So each one of these elements create that company of value. That's what we're talking about here. Creating a company of value that someone is going to want to pay a premium for when you're ready to move on to your next adventure, whatever that may be. So, marketing strategies. What's the value here? I want to sum it up in one word: brand. The longer you're in business, the more the brand of your company is going to be recognized. When you think about some of the big companies, right? Coca-Cola, Nike, Adidas, think about the ones that you recognize that have brand recognition. They have a very high value. There's a value proposition there. It's an intellectual property. So when you look at brand, if you have a strong brand, you're going to have a higher valuation because that's what's called intellectual property. And that intellectual property does have a value to it. You're probably also going to have increased customer recognition. Again, with the better the brand, the stronger your brand, the more it's going to garner attention from customers. And that customer database is very, very important to someone who wants to acquire your business because those are built-in customers. Your brand also attracts potential buyers. Again, we talked about the marketing strategies, knowing your ideal customer, knowing how to talk to them, and then understanding what is the value proposition from spending money to be able to attract them. And then think about your brand around the familiarity of your products or services to gain new customers. So the better your brand, and perhaps it's longer in business, or maybe you've been not 5 years in business, but you've already built a wonderful brand. This creates opportunity for you in terms of value. Now, continuing our marketing strategies, when you have a very good brand, people know who you are. Think about it when you were in business initially, right? When you first started your first 2 years in business, for all of you small business owners out there, you know what the first 2 years are like. You work your off, right? So you know what that is like. You're building a brand. You're trying to get people familiar with who you are. But over time, as you have that brand and you continue to work on it and attract new customers, then refer you to other customers, that's the brand that has the value proposition. It creates more growth potential for you. It also has market share and increases your market share. And then the acquiring business may like you because there's complementary products or services, so that you become very attractive to them because they are knowing about who you are. Then that gains their interest about, I might be able to acquire this company to increase my potential and scale my business. So let's talk about the second point of focus, financial structure and growth, and what value does that bring when you are looking at an acquisition, or if you're the seller, on a purchase. So think about it from a financial structure and growth. Your profits. The more profitable you are, and I got to encourage you to make sure that your financial statements are up to date and that you've got a good accountant or bookkeeper helping you on your financials. The more profit there is, the higher the value, obviously. And in previous webinars and workshops, I always talk about the working capital ratio, which if you remember that ratio, it's a very easy one. You can find how to calculate it open up your balance sheet on your QuickBooks, FreshBooks, whatever it is, and then run your balance sheet, and then take your total current assets, which is usually your cash and accounts receivable, maybe inventory. So your current assets, your total current assets, divide that by your total current liabilities. So if you had $1,000 in cash and $1,000 in credit card debt, it's exactly 1-to-1, meaning that you have just enough cash to pay off your current debt. If it's less than 1, you're not in good shape. As a buyer, you want to make sure that that ratio is much higher than 1. But if, let's say, for example, it's 3-to-1, 4-to-1, 5-to-1, I have 5 times more assets than I do debt. That means I'm 5 times more likely to be very successful in the future if I'm buying your company, because I'm investing money in your company and I want a return on that investment. 5-to-1, 6-to-1 tells me you're a cash cow. And when you have profits, it increases the buyer's confidence that that return on that investment they're seeking will continue. And if there are higher profits and you are in that range of 5-to-1, you will have a quicker sales process. You will have multiple buyers coming to your doorstep to buy your company. That's why the financial structure and growth quadrant of the 4 points of focus is so very important. It's a big negotiating power for you. You can garner more value, more dollars for your company when you're ready to sell. And it helps reduce the risk. Because you're a financially stable company, it's going to reduce the risk for the buyer. Because again, they're looking at what's my return on my investment? Am I going to be able to continue to run this business after the buyer steps out? And I want to make a point here, and we'll get into operational excellence. If you are considering buying a company, please seek out someone who can help you work through this process. And I know of history of people buying companies, and it's not the panacea if you don't do your due diligence and you do your ratio analysis. I strongly recommend that you do ratio analysis, that you do data analytics on a company that you want to purchase. Now let's talk about operational excellence. Hugely important. That's our third quadrant in the 4 points of focus. So when you think about it, when you have continuous improvement, when you have systems that talk to each other, that equals a higher valuation, because again, that buyer knows that the company can run without the seller. Very, very important. It will increase the buyer's confidence. If you have your processes documented, and if you have systems in place to run the company efficiently, number one, it's going to drive more profits to the bottom line. You hear me talk about that all the time. But more importantly, it increases the value of your company, and it increases the buyer's confidence. It leads to a quicker sale because the buyer knows that the company can run without you. You then, as a seller, have more negotiating power. It reduces the risk to the buyer because they know that the company can run very efficiently. They have technology that's in place to help them move forward as they start navigating a new frontier for this purchase that they've just done. And if you have things like HIPAA and other requirements, and you follow the compliance strategy, again, it increases the buyer's confidence that you've done all the right things in order to make the company successful. Now, the fourth quadrant, people and team building, very, very, very important. You've heard me talk about various factors that a buyer will look for. One of them is financial structure, financial strategies, right? Are your financial statements up to date? Are you a cash cow? I just talked to you about the working capital ratio and why that's important. How stratified are your customers? How stratified are your vendors? And your people. You've heard me talk about the operations of the business, but your people, who are in your company, so very important. Who are the key players? If the buyer knows that you've got key players that know what they're doing and their standard operating procedures to continue running the way it should be run without the seller, higher value, way better for you. Again, it increases that buyer confidence that they can rely on those people when you're gone. You think about this with a good culture and good people in place, the buyer's more likely to want to close that sale. It increases your buying power, your negotiation. And when you think about your management team and reducing the risk, the better they are about functioning in the business, the more profitable the business is going to be, and it continue to carry on without the seller. That's very, very, very important. Management team is a huge factor in creating an opportunity. So those are your 4 value propositions: marketing strategies, financial structure and growth, optimization or operational excellence, people and team building. Those 4 elements build a company of value. So let's talk about different valuations of how to determine what your company is truly worth. One of these is called market capitalization. And this is where a lot of public companies do this market cap. You've heard of market cap when you're looking at maybe to invest in a stock, or if you're out on the Dow Jones or looking at NASDAQ and various companies, you've heard of market cap. So it's the share price times the number of shares outstanding gives you a market capitalization. Most private companies don't determine market cap. It's more for the public companies, but I wanted to mention it here. Another area of looking at valuation for your business, in other words, what is your company worth, is book value. And again, if you go to your balance sheet, go to your QuickBooks or FreshBooks, whatever accounting system you're using, print your balance sheet. If you take your assets, your total assets, and subtract your total liabilities, gives you that net worth. That's book value. What's left over after, again, you have taken all of your assets to pay off all your liability. What's left over is your book value, the net worth of your company. When we are setting up a company for sale and we're listing that company for sale, usually it's not book value that is done. We either go through a discounted cash flow, which is a system where it uses the present value of future cash flows. And it's a very involved way of looking at the value of a company. And then finally, you can look at what transactions occurred in the past. So this creates more of a market valuation. So if you think about it like this, you own a house, right? You want to sell that house, you want to buy another house. When you put your house up for sale, that realtor is going to look at what other companies have sold, what other homes have sold in your location or in surrounding location to help determine what the market value is of your home. Works the same way when we talk about market value for a business. What have other businesses sold that are in your industry that are very similar to you in size? What did they sell for? And then we get a weighted average of that. If you want to know a little bit more about valuations, I'd be more than happy to talk to you about this, but this is a top level view. It does get into a little bit more detail. Happy to have that conversations with you. So now let's switch to, how do you know if it's the right time to sell? Well, there's a lot of different factors, and many of these are going to be personal to you. Right? You have worked many years. You've built up your company. You've built up a value for your business, and you may want to exit. Now, if you're looking for either a merger or an acquisition or a strategic buyout, when we look at corporate cash, especially if it's a strategic buyout, if there's a lot of cash that companies are carrying, that might be an indication to sell. Another one is low interest rates, because liabilities, which would be in this case loans, like an SBA loans, are a little bit easier to get when the interest rates are lower. Now, we have seen the interest rates come down 0.5%. I believe we're going to have a couple of more before the end of the year, probably 0.25% in November and 0.25% in December. So as the interest rates come down, puts you in a better position to be able to sell your company way quicker than for it to sit on the market for a while. And then strong economic growth. We have actually seen the trend. We went through a rough period through COVID, and then a couple of years after that, that's just part of the process. The supply chain was suffering. There was people were out of work. It's just part of what happened in COVID all around the world. But now we've seen indicators where inflation is down to that 2.3%. Interest rates are falling. We've seen good, strong economic growth within the last 2 quarters of this year, which are all good indicators that it might be the time to sell. But again, it all depends on you and the journey that you're on. Perhaps there's other factors there that will make your decision. Now, let's talk about different types of buyers. You heard me talking throughout this workshop about different buyers and what goes through buyers' minds and etc. And I've kind of alluded to that throughout this whole workshop, but let's be a little bit more specific. A strategic buyer. These are companies that are looking to expand their operations. Remember when I told you I was a CFO for that software company? We were actually bought out by a strategic buyer. It was a public company. They bought our technology so that they could then expand their operations. Again, a strategic buyer, expansion of operations. There could be a financial buyer. Now, this is a business that wants to buy you as an investment because they see you as a good opportunity. They may then put more money into the company and then sell it 5 years down the road. A financial buyer might be someone like a VC, a venture capitalist, or a private equity firm, what we call PE. So those are potential buyers of your company looking to put investment into it that they can then later expand and maybe resell your company. The third buyer is an individual buyer. So in my previous example, let's say that they are someone that's retiring from corporate, or let's say that they have worked in corporate, but they've owned a business before. Now they want to leave corporate and they want to start a business again. These are individuals. They own it. They're owners and operators. So those are the individuals that are looking to own it and operate it. And it's very key for them to get that return on that investment that we talked about earlier. And then finally, we've got employee buyers. This is a great option if you want to think about leaving a legacy for your business. You've got some loyal employees that you want to make sure that you are able to provide an opportunity for them to continue your business. Now, putting this all together, right? What does this look like? And you've heard me talk before about a 12-step process of selling a business. It is very involved. When you go into this, make sure that you have a team built around you. Do not try doing this by yourself. So you want to look at industry publications. You want to do a little bit of research. What are the latest trends? Start looking at what's happening in your industry to see if it's a good time to sell. So remember, it takes about 8 to 12 months to sell a business, and you should take at least 36 months to start planning the sale. There's tax implications, tax strategies that you can use. You want to make sure your financials up to date. You're going to need to go back 3 years in presenting what we call a confidential information memorandum, or CIM, that you present to potential buyers. Those financials need to be solid. The next thing you want to look at is online resources. What's out there to help you get educated? Networking is an option for you as you're telling people, and we all, as business owners, we all know other business owners. You may tell them in confidence, hey, I'm thinking about selling. And I certainly have gotten referrals that way by other business owners talking to somebody who says, yeah, I think I'm ready to move on to my next adventure. Then, reach out to North Star Strategic Partners and see how we can help you be able to help you build that sales team. Another person you might want to talk to is a business valuation expert. Now, there are different types of business valuations, as I mentioned before, and there are different types of business valuation experts. For example, a business broker or someone like us, North Star, we can create a valuation for you based on market sales, etc. Let's say from the SBA. But there are also valuation experts that will determine what the value is for your intellectual property. That's very, very specific, very important. If you have intellectual property, to get a valuation expert, and I have some referrals for you if you're interested in that. Also, a merger and acquisition advisor, an attorney, very, very, very important. If you are wanting to sell to somebody that you know, that's okay. You can hire a consultant like ourselves to help you, but I highly encourage that you use an attorney for that purchase agreement so that everybody is on the same page and all the I's are dotted and the T's are crossed. And also you can use a CPA. Okay, I'm a CPA and a tax professional. It's important for you to know what are the tax strategies that are out there to save you money so that you pay what you're supposed to pay in taxes, but not a penny more. So John Warrillow, I love John. He's the author and founder of the Value Builder System. This is a quote from him. It's so very, very important to understand this. A business is not just an asset. It's a collection of relationships, processes, and systems that create value. Remember, we talked about that value, right? Creating that value for your business through profitability, sustainability, and scalability. And during this webinar, we were talking about automated systems and standard operating procedures and why they're important. The best businesses are built to sell. They're designed to be easy to understand, operate, and transfer to a new owner. We touched on all of that on the 4 points of focus: marketing strategies and how to build value there, financial structure and growth, how to build value there, operational excellence, how to build value in that quadrant, and fourth, people and team building, how to build value in that quadrant. So when you think about this quote and you read through it, think about how the 4 points of focus help interrelate so that you can create that company that you're going to get the maximum value for. Now, next steps. And if you want to check out our book, The Only Business Compass You Ever Need, The 4 Points of Focus, it goes into more detail about the 4 points of focus, and also in the last chapter, how to exit. So it gives you some great more detail that I didn't touch on here in the 45 minutes or so that we have. But if you want to find out a little bit more, I give a free 30-minute consult. Happy to talk to you about exiting your business. And if you want to move forward with us, we can talk to you about implementing the 4 points of focus and how that's going to help you build that company of value that you're looking for. And here's some of our services. We do strategic coaching and advising using that 4-point method that we've talked about. We can do an evaluation and help you create those operational processes. If you don't understand what those are, if you're not sure where to start, we can certainly help you with that. We have a customized cash flow management system, help you build on that financial structure and growth. And we have CFO services on demand or fractional, as well as we can help you create some of those key ratios and KPIs that we talked about today, like the working capital ratio and some other ratios that I'm sure you've heard me talk about in workshops. And then finally, we can help you build that market valuation to see what is your company really worth, and is it the right time for you to maybe think about selling, or maybe you're thinking about purchasing a business. We can help you there as well. So this is how you can contact us, and here's our telephone number. That's to our office, as well as you can schedule a discovery call on our website. One thing I will comment on is that don't do this alone. Get your team together. Do think about what it is that you want to do and start planning in advance. Make sure that you understand what the due diligence process is when you're selling a business, because the buyer is going to be looking at your business. They're going to kick the tires, they're going to look under the hood, and they want to make sure, again, I was talking about confidence. The higher confidence level in the buyer, the more likely they're going to pay a premium price for you. So put in the time, do your research, get your team together, and make sure you're ready for due diligence so that you can have a quick sales process that's going to reward you when you sign on that closing statement. I'm done. And I dot the I, and I'm off to my next adventure. So this is our final webinar of 2024. Again, we're going to revisit the 4 points of focus in more detail. So that is the last Tuesday, October 27th at 1 p.m. And we usually schedule about an hour, but I usually take about 45 minutes or so to go through the process. Also, we're going to have some more details coming up in our 2025 calendar year so that you can see what are our coming webinars starting in January. And I want to thank you for spending time with me today. I know your time is very valuable, and I'm hoping that I was able to bring you some little nuggets that you can take away and help you in your business. And if you're thinking about, selling your business, hopefully you've garnered some information here that can help you formulate a better decision. And with that, thank you. And I'm open for questions, Shai.
Thank you, Wendy. We have room for a couple of questions. One of the questions is that you mentioned about the indicator of the timing of selling a business. How can these indicators influence the business owner's exit strategy?
Mm-hmm. Well, like I said, this is really a personal journey for you, right? Depending on where you are in your life cycle, depending on where your business is in its life cycle. But I think at the end of the day, you got to look at some of the external factors as well, such as, the economy, how we talked about the cash and inflation and, interest rates, etc. Those are the external factors. The internal factors within you and your company are, where do I stand right now? What do I want to be, or what I want to do in 5 years or 10 years, whatever the case may be? Where am I with my family? All of those internal factors really go into a decision of whether or not you want to sell right now, if you want to do it later down the road. And then you got to consider the external factors as well. So again, I think it's a very personal journey. I'd be more than happy to talk to that individual who posed that question. But again, it's a journey that I think we all need to address, and it's one that it's personal. So external and internal factors. Hopefully, answer that. Go into your decision.
Thank you. And this question. This is an interesting question. Do you have any suggestions on how I should inform my employees that I'm selling the business?
Mm, great question. So it is a matter of timing, and it really depends on what exit you want to do. If you're doing a strategic exit, or if you're being acquired, that's going to have a different strategy than if you're selling to employees, right? So if you're doing a strategic, or let's say an outright acquisition, I would say keep it to a minimum. Just your very, very, very key individuals would know this. And those are people that you have strict confidence in and trust them 150%. Because what you don't want to happen is good employees hear about, oh, we might be sold, and they leave. And then that's going to hurt your valuation. Big companies in the public realm, when they acquire other companies, it's very, very close knit of who knows what the acquisition is on both sides, on the buyer and the seller. Very small number of people know about the acquisition. You should operate the same. Now, if you're selling to employees, you might be more upfront. Start planning in advance, saying, hey, I want to sell to you guys, so that they start thinking about how we can start moving forward. Those again, is part of your personal journey, and those are choices you're going to have to make. And it's going to be dependent on how you're going to exit. Hopefully answered that question.
Thank you so much. Those are the questions that we have for today.
Awesome. All right, everyone. Thank you so much. Again, I appreciate you so very much for spending time with us today. I'm hoping that you found this workshop informative and that you can take away some wonderful knowledge that you can apply to your business. With that, thank you very much. Have a wonderful rest of your day, and we'll see you next month, October 27th, for our final webinar. We're going to be talking about, excuse me, the 4 points of focus, tax strategies, and what to think about as we're coming up at year end. Thanks so much, and we look forward to seeing you again. Thank you.